You've spent decades doing everything right, contributing to your 401k every paycheck, watching the balance climb, telling yourself that all those years of discipline are finally going to pay off in retirement. But here's something most people don't find out until it's too late. A significant portion of that account doesn't actually belong to you. It belongs to the IRS. And in retirement, they are going to collect every dollar they're owed, whether you're ready for it or not. This is what's commonly called the retirement tax bomb. And right now, millions of Americans are sitting on one without having any idea it's there. Here's how it works. When you contribute to a traditional 401k or a traditional IRA, you get a tax break up front. The money goes in pre-tax. Your taxable income drops. Your paycheck feels more efficient. It genuinely feels like you're winning. But the IRS isn't being generous. They're being patient. Because every single dollar inside that account, every contribution, and every dollar of growth it ever generated is sitting there as future taxable income waiting to be collected. You didn't avoid the tax. You deferred it. And deferred taxes have a very specific way of coming due, often all at once. At the exact moment you can least afford a surprise. Americans currently hold over $11 trillion inside traditional retirement accounts. The overwhelming majority of that balance will eventually be taxed as ordinary income, not at capital gains rates, at ordinary income rates, the same rates that apply to a regular paycheck. For a lot of retirees, that distinction is a shock they were never expecting. Now, the deferred tax problem alone would be manageable if you could control the timing. The real issue hits at age 73. That's when the IRS enforces something called required minimum distributions, or RMDs. Starting at 73, you are legally required to withdraw a specific percentage of your retirement accounts every single year, whether you need the money or not. The government calculates that amount based on your account balance and your IRS life expectancy table, and the required amount grows as your balance grows. Let's make that concrete. A retiree with $1 million in a traditional 401k at age 73 faces an RMD of roughly $40,000 that year alone. At $1.5 million, that forced withdrawal climbs to around $61,000. That entire amount gets added on top of everything else you're receiving: Social Security, any pension, any part-time earnings. And suddenly your total taxable income for the year is far higher than you ever planned or expected. And that creates the next problem most people never see coming: tax bracket creep. Most people assume their taxes will be lower in retirement because they're no longer earning a full salary. That logic feels reasonable on the surface, but it collapses quickly once RMDs arrive. Those forced withdrawals can push a retiree from a 12% bracket all the way into 22%, 24%, or even higher in a single tax year. And that same income spike activates another expensive trap: taxation on Social Security benefits. Social Security is not automatically taxed, but once your combined income crosses certain IRS thresholds, a portion becomes fully taxable. For single filers, that threshold starts at $25,000. For married couples, it starts at $32,000. Once income crosses $34,000 for singles and $44,000 for couples, up to 85% of Social Security benefits can become subject to income tax. Large RMDs can push retirees across both of those thresholds in a single year. Not gradually, all at once. But there's still one more layer that almost nobody anticipates until they open the bill: Medicare premium surcharges. Your Medicare Part B and Part 500 premiums are not a flat rate for everyone. They are income-based. If your income exceeds certain levels, the government adds what's called IRMAA, the income-related monthly adjustment amount. At moderate income levels, that surcharge can add several $100s per month to your healthcare costs. At higher income levels, it can exceed $500 per month per person. And here's the part that stings the most: A large RMD in one calendar year can trigger IRMAA surcharges that follow you through the entire next year. One forced withdrawal. 12 consecutive months of elevated Medicare premiums. It's a consequence most retirees have never heard of until they're already paying it. So the total cost of the tax bomb isn't simply the income tax on the withdrawal. It's higher bracket rates activating, Social Security becoming taxable, and Medicare surcharges all layering on simultaneously, triggered by the same mandatory distribution you had no legal choice but to take. So what can you actually do about it? The most powerful tool available is a Roth conversion. The concept is straightforward. You take money from your traditional pre-tax retirement account, pay income taxes on it now at your current rate, and transfer it into a Roth IRA where it grows completely tax-free. Future Roth withdrawals carry no income tax. Roth accounts also have no RMDs during the owner's lifetime, which eliminates the forced withdrawal problem entirely. The most valuable window for Roth conversions typically falls between the year you retire and the year you turn 73. If you stop working at 62 or 65, you often have several years where income is at its lowest, before Social Security maximizes, before RMDs begin, before Medicare surcharges apply. That low-income window is one of the most valuable tax planning opportunities of your entire financial life. Most people let it pass without doing anything at all. Converting $50,000 to $100,000 per year during that window can meaningfully reduce future RMD balances, lower lifetime tax exposure, and protect a larger share of your Social Security from ever being taxed. The other strategy is less dramatic, but equally important. Diversify your account types before you retire. Most people have nearly everything in pre-tax accounts because that's the default. Building a balanced mix of traditional accounts, Roth accounts, and taxable brokerage accounts gives you control over which bucket you draw from each year. The flexibility lets you actively manage your tax bracket instead of having the IRS force your hand through mandatory withdrawals every year. The retirement tax bomb isn't a loophole or a technicality. It's the straightforward result of tax deferral doing exactly what it was designed to do. You received a benefit up front. The bill comes later. The difference between a retirement that feels financially comfortable and one that constantly feels squeezed often comes down to one factor: not how much you saved, but how much of what you saved you actually get to keep after taxes. So here's the question worth sitting with. Do you actually know what your estimated tax bill looks like in retirement, or have you just been assuming it'll work itself out?